Okay, let's get right into it today. We're cutting straight to the core of what's been moving the markets recently. Welcome to the deep dive. We take your stack of sources, filter through the noise, and give you the critical knowledge you need. And today, our focus is really on this surprising market resilience. It seems to be fueled by, well, two big things: genuinely strong corporate earnings and inflation data that came in unexpectedly cool.
Yeah, that resilience is definitely the main story. It's quite something. Markets really mounted a vigorous recovery this past week. And that's despite some pretty significant headwinds still blowing.
Wait, like the ongoing U.S. government shutdown, that's still casting a huge shadow.
Exactly. And those persistent global trade tensions haven't gone away either. But somehow we saw this sudden, quite decisive return of risk appetite.
Which brings us straight to the big takeaway, doesn't it? The street now seems really confident, betting that the Federal Reserve has enough, let's say, cover to follow through on not just one, but actually two more rate cuts this year.
Precisely. That policy expectation is really what's powering this whole move, is confidence.
Yeah, it feels like the narrative has completely shifted from, uncertainty about tightening
Uh-huh.
to this feeling of almost assured easing.
It's a big change in sentiment.
And you really see it when you look at the weekly performance numbers. I mean, the rally just shook off all that anxiety from the week before. I remember all the chatter about bank balance sheets, global recession fears.
Oh yeah, that seems like ancient history now.
Doesn't it? And look at the numbers. S&P 500 up 1.9%, the Dow Jones climbing 2.2%, and the Nasdaq actually leading the charge, up 2.3%. That feels like a major vote of confidence from investors.
It really does. And interestingly, that confidence, you can always trace it back to a single data point. It was the U.S. Consumer Price Index, the CPI, for September. It just came in below what everyone was expecting.
Okay. So that was the trigger.
Pretty much.
Yeah.
It gave the Fed the political and economic cover they arguably needed. It essentially cemented the case for continued easing, in the market's eyes anyway.
Yeah. And that confirmation is so crucial, right? Because it immediately sent a signal to the Treasury market. We saw a yield pullback pretty quickly after that.
Exactly. Lower yields ease borrowing costs right across the economy.
Yeah.
And that's, the fuel you need for any kind of major sustained rally in risk assets like stocks.
And this wasn't just a U.S. story, was it? The optimism spread.
Oh, absolutely. We saw strong global echoes. You had purchasing managers indices, the PMIs, in the Eurozone, Germany, and the UK, all beating forecasts. And what's also pretty significant, I think, is the UK CPI. It came in softer than expected, too, which gave the Bank of England, quote, room to stay patient. So policymakers internationally are probably breathing a little easier as well.
Right. And you could actually see that playing out in real time in the currency markets. The euro strengthened against the pound sterling directly because of those different central bank dynamics. It just shows how interconnected everything is. A policy hint in one region can instantly ripple across valuations globally.
It really does. It highlights just how nuanced this whole policy environment is right now. You can't look at anything in isolation.
Okay, so let's dig into a really interesting twist here. Because this rally, it feels structured a bit differently than maybe what we saw earlier in the year. The sources are pointing to a broadening breadth. It sounds like smart money isn't just piling into the same old winners. There's active rotation happening.
Yeah, that's a really critical observation. The rally is finally expanding beyond just those high-growth tech names that dominated for so long. Investors are actually shifting out of what some are calling the AI stack.
The AI stack. So you mean the big chip makers, some of those really high-flying software names, cloud providers?
Exactly, that whole complex. And they're also rotating out of metals, which is interesting.
Okay, but wait a second. If the case for Fed easing is supposedly cemented and lower rates theoretically boost growth stocks, why are investors cycling out of high-growth AI and into defensives? Doesn't that seem a bit contradictory?
Well, that's where the nuance of the policy bet comes in. It's not quite that simple.
Yeah.
Moving into more defensive areas like industrials, healthcare, consumer staples, it tells us investors aren't just betting on some massive, unchecked growth boom.
Okay.
They're hedging. They're sort of positioning for more of a softer landing. They might be preparing for the possibility that the Fed cuts are actually, a response to some underlying economic weakness, not just a green light saying the coast is clear.
I see. So it's less everything's amazing and more things might slow down, but the Fed will help cushion it, so let's get into safer stuff.
Exactly. It implies maybe a more sustainable, broader rally, but potentially a slower growth outlook overall.
That makes a lot more sense. So the rotation is actually a sign of more strategic, perhaps longer-term positioning, not just chasing short-term heat.
Precisely. And speaking of surprising movements, we absolutely have to talk about the shock in the commodity world, specifically gold. We saw gold prices drop.
Yeah.
Get this, more than 6% in what was genuinely one of the wildest trading sessions in a decade.
Wow, 6% for gold.
Yeah. It snapped a huge 10-week winning streak. That kind of sudden volatility, especially for a traditional safe haven like gold, is extremely rare. It really reflects a massive shift in confidence, maybe away from safe havens and towards equities or even fixed income now that yields look a bit more stable.
And meanwhile, crude oil was also volatile, but it seemed immediately reactive to government policy moves. It really underscores how political the oil market still is. Oil briefly dipped into the mid-$50 range, but then it rebounded almost instantly. And it was triggered by two specific government actions, right?
That's right. First, the U.S. Department of Energy announced plans to purchase 1 million barrels for the Strategic Petroleum Reserve, the SPR.
Okay, so that's immediate, guaranteed physical demand right there.
Exactly. Provides a bit of a floor. And the second thing, the Trump administration added sanctions targeting Russian oil producers.
So supply-side concerns coming back into play.
You got it. Both actions provided a clear, almost instant policy floor under prices, pushing them back up. It just shows how sensitive the supply side remains.
Okay, let's shift gears then and look at the corporate report card. Because this is really where those big global themes, policy, trade, inflation, hit the actual bottom line for companies. And the industrial sector seemed to deliver some unexpectedly strong results, suggesting maybe this broadening rally has some real earnings power behind it.
Yeah, this section really illustrates those conflicting economic forces perfectly. I mean, take 3M, for example. They delivered a stellar quarter. And the really counterintuitive nugget here for you to remember is they specifically cited resilient China growth.
In China, despite all the tariff pressures we hear about constantly.
Exactly. Despite the headlines, it suggests that underlying domestic Chinese demand for certain quality industrial goods is still incredibly strong. It's acting as a kind of buffer against that broader trade instability.
That's fascinating. Okay, contrast that with, say, GE Aerospace, GE.
All right. GE Aerospace topped expectations. They raised their full-year guidance, and they announced a massive $5.3 billion acquisition. They're buying the remaining 50% stake in Prolec GE.
Wow, $5.3 billion. That's confidence.
Huge confidence. It shows real conviction in the aerospace and defense cycle, leading them to deploy capital pretty aggressively.
And then you had General Motors, GM, also crushing estimates. Stocks surged.
Yep, and GM benefited directly from lowered tariff risk forecasts. It just shows how even the expectation of trade becoming more stable can unlock immediate value for these big multinationals, especially those reliant on really intricate global supply chains.
But it's not all smooth sailing, right? The flip side shows just how fragile things can still be. Ford, dollars, for instance.
Yeah, Ford's a good example. They reported a solid Q3. Things looked okay, but they had to trim their full-year guidance. And the reason was very specific. Supply disruptions caused by a fire at one supplier, a company called Novalis.
Just one supplier fire.
Yeah.
And it forces them to cut guidance.
That's right. A single incident ripples through the chain. Boom. Guidance has to be adjusted. It shows the lack of slack in the system sometimes.
And that fragility seems amplified in the tech world by direct policy volatility. Tesla, TSLA comes to mind.
Absolutely. Tesla missed expectations. And they specifically flagged uncertainty tied directly to global trade shifts and, well, rapid policy instability as a risk factor for future quarters.
Yeah.
It's just really hard to forecast confidently when the basic rules of global engagement feel like they're changing week by week.
But maybe the most interesting structural shift here is this fascinating policy pivot we're seeing in tech. It feels like government backing isn't just about tariffs anymore. It's becoming strategic industrial policy, like Google, GOGL, landing that multi-billion-dollar cloud deal with the AI firm Anthropic, and notably grabbing that business away from Amazon's AWS. That just shows the incredible competitive pressure in those AI cloud wars.
It really does.
Yeah.
But then you have even more explicit government support acting almost like a giant venture capital fund. Take Oklo. It's a nuclear startup. Their stock jumped after reports that these new nuclear startups will actually gain access to U.S. plutonium stockpiles.
Access to plutonium stockpiles, wow.
Yeah, it signals really strong, active White House support for accelerating innovation in the nuclear sector. It's suddenly being treated as strategically essential again.
So it's less like a simple subsidy and more like the government actively deciding to become a strategic investor, almost like a VC, for national security plays. And we saw something similar with quantum computing stocks, right? They rebounded hard on reports the U.S. government is considering taking equity stakes in the sector.
Exactly, to secure a strategic future. We are literally watching innovation being directly subsidized, protected, and integrated right into national security strategy in real time.
So if we connect this back to the big picture,
hmm
it feels like government policy is really acting as a force multiplier now for specific strategic technologies. It's actively shaping the future winners and losers, especially where tech meets national security.
Couldn't agree more. It's a huge factor to watch.
Okay, so let's look ahead then. Because while sentiment is definitely up and earnings were generally pretty positive, we still have this massive shadow of the U.S. government shutdown limiting data visibility. That feels like a huge handicap.
Oh, it absolutely is. We're basically navigating the next few weeks with like half a map. Really critical market-moving data points are just paused because of the shutdown. We're talking durable goods orders, new home sales, GDP data itself, and the Fed's favorite inflation gauge, the PCE price index.
So we're missing core gauges of the economy right when these major policy decisions are about to be made.
Precisely. It's not ideal, to say the least.
That lack of visibility makes the critical dates coming up this week even more important for you to track. The massive market driver is obviously Wednesday at 2:00 p.m. Eastern Time, the Fed interest rate decision, and the FOMC press conference that follows. This is where the market fully expects that first of the two rate cuts we talked about earlier.
Yeah, all eyes on Wednesday afternoon. Outside of the Fed, there really are only a few data points to even chew on. We get the CB Consumer Confidence Report on Tuesday.
Okay, one of the few not paused.
Right, but pretty much the rest is on hold until Congress gets its act together.
And we also need to keep a really close eye on the trade watch, right? The rhetoric between the U.S. and China remains, well, heated. But the critical piece of certainty that seems priced into the market is that the Xi-Trump summit is still confirmed and on schedule for next week.
That's key. If that schedule starts to wobble for any reason, market confidence could wobble right along with it. And, we also saw Canada briefly pop up again as a minor trade flashpoint concerning auto imports. Just a reminder that global trade stability is still a pretty fragile high-wire act.
Good point. And then after the Fed decision on Wednesday, we'll have a busy slate of Fed speakers to parse through Bowman, Logan, Bostic.
hmm They'll likely offer context and probably try to reinforce the market's current easing expectations.
So the core tension, the thing for you to really watch closely, is this. Markets seem to be betting heavily on the policy future, those seemingly assured Fed cuts, a stable Xi-Trump summit.
Right, pricing in the certainty.
Exactly. But they seem to be willfully, or maybe hopefully, ignoring the chaos of the present, which includes the longest government shutdown in a decade and all this active policy volatility we've been talking about. If that shutdown continues much longer, well, that confidence feels like it's on borrowed time.
That disconnect is absolutely the most fascinating dynamic in the market right now. How long can it last?
Absolutely. And that leaves us with a final provocative thought for you to mull over. History lesson. The longest government shutdown in the last 10 years was 35 days. Getting close to that territory again. Now, given the current, maybe faint, hints of an end, do you think the government shutdown will actually conclude before the Fed makes its big move on Wednesday? Because if it doesn't, well, you could see that market confidence evaporate pretty darn quickly. Something to think about. Thanks for diving deep with us.